Hello, value investors. Over the next 3 minutes, I'm going to help you identify a value trap. I lost money in this business, and I believe that you could learn something from just watching this video. And I wish I'd watched it before I lost the money. So I'm going to tell you the name of this business at the end, but I've removed the name of the business so that you can just focus on the financials and removes the rhetoric. So since 2015, this business has not grown its revenues. Indeed, the business has very slowly declined its revenues. And you can see that its cash flow from operations has gone from 300 down to 200, down to less than 100 in 2019. And despite the business cutting back on its capex, the amount of free cash flow similarly continues to decrease over time. At the end of 2019, it made 81 million of free cash flow. So you can see it has declined. You look on its balance sheet, and you can see it has 117 million in cash and cash equivalents. And you can see it holds a current debt, that means debt that has to be paid over the next 12 months, of 180 million. And you can see that it has 680 million of long-term debt. Okay, so it has close to 800 million of debt. And you can see, if you look under the SEC filings on the 10K, contractual obligations, if you control F that, contractual obligation, you can see long-term obligations, and you can see 2020, which is this year, and you can see the debt and everything that it's basically can't get out of. So even without knowing too much about this business, even you just see straight away that this business is going to struggle. Not to mention when you get to the next following years, there's no way it's going to survive. So I believe that you can get a lot of information from a business, in my opinion, if you look at the free cash flow margin. So the free cash flow margin is free cash flow divided by revenue expressed as a percentage. So if you see that a business is making, this is 80 million over 2 billion of revenue, it's approximately 2.5, the free cash flow margin. That's kind of a mediocre business. But a few years back, it was making double that, more than double that, so it's cleaning 5%. Anything, in my opinion, above 5% is a reasonable business. It roughly equates to a return on invested capital of approximately 15%. So Buffett always says that try and look for businesses that have high returns on invested capital. Obviously, the higher the better. That means it's an asset-like business. So anything above 15% return on equity is great, or return on invested capital without including debt of above 15%. But a free cash flow margin of above 5% is also a reasonably good business. So the business I was talking about is GNC, and you can see that the market cap is only 33 million because it's pretty much priced for bankruptcy. And you can see that the share price has been declining over time as investors throw in a towel. I was one investor that was very bullish this company, and I lost money as well. So yeah, this is something that maybe you will find useful. If you like, subscribe, and I'll see you soon. Bye.